Bitcoin is often classified as a high-risk asset, but we cannot deny the fact that Bitcoin is the best asset of this decade with a compounding return of more than 80% per year. So, we will talk about how risky Bitcoin is with various tools. First of all, nothing in this video is financial advice. It's purely 100% educational content that's meant to help you on your Bitcoin and crypto journey. My name is Seth Noah. You are watching Decentral Money. Please subscribe to our channel as a way to support us. Without further ado, let's get started. First, let's check on Bitcoin's performance. At the time of this video, Bitcoin generated a return of 161% year to date. Bitcoin has also achieved a compounding return of 30.7% over the past 10 years. So what about the S&P 500, which serves as an investment benchmark? It only had a return of 9.77%, and it's a huge difference in terms of return. But if we check further, the performance of Bitcoin has also surpassed S&P 500's for 14 years. If Bitcoin is a scam, how could Bitcoin last for 14 years? And many countries such as Canada have also launched Bitcoin Spot ETF. So the risk of Bitcoin is actually much smaller if we compare to other assets like the S&P 500. I think this is because the reward is much higher than the risk itself. And yet, Bitcoin's global adoption is only at 4. We still have a long way to go. Next, let's check on Bitcoin's drawdown. If we look at Bitcoin from the drawdown alone, it's clear that Bitcoin is riskier than other assets like the S&P 500, for example. The drawdown in the beginning, when Bitcoin was ever created, was indeed significant because it's a new asset class and there was no adoption yet. It's different from the S&P 500, which has been around since 1957. The difference is that Bitcoin will bounce back much stronger and higher after a drawdown. And you can see that its drawdowns are smaller from time to time. The reason is mainly because of the halving, an event where the block reward for miners is cut in half and reduce the new supply of Bitcoins in the market. Also, don't forget the adoption. We have new users, new wallets, new people holding Bitcoin instead of fiat. If we compare to other assets like real estate, for example, real estate also have drawdowns, but there is no price feed. And real estate is not a liquid asset. So in the end of the day, it's better to have Bitcoin with deep drawdowns because Bitcoin is liquid and has the potential for much higher pumps after a drawdown. What about the risk of Bitcoin from government regulation? Well, it depends where you live at. But in my country, government has been legalized Bitcoin and launched Bitcoin tax law, so people can report their Bitcoin holding on their tax report. In some other country like Singapore, capital gain on Bitcoin is not taxable. If you live in El Salvador, you can use your Bitcoin to pay almost anything in your daily life. Even in the US, there is no law that force merchant or people to use certain currency or coins. Private business in US are free to develop their own policies. And more than 250 companies accept Bitcoin as a medium of payment. Bitcoin is global free market. Any government cannot ban Bitcoin. Next, let's talk about Bitcoin risk from the volatility perspective. Bitcoin prices are indeed volatile, as I explained in the first point. So, why? The first reason is because Bitcoin's market cap is still small. The market cap of Bitcoin at the time this video was made was below $1 trillion, while the market cap of the S&P 500 reached $38.4 trillion. Just imagine if the market cap of Bitcoin was only 1/3 of the S&P 500. How much would the return be? The price of Bitcoin is indeed volatile because it has only achieved 4% adoption. But what if this 4% becomes 8, or even 12, or maybe even 50%? I am certain that sooner or later, Bitcoin adoption will increase by tens of percentage points. Its narrative alone has been widely used in presidential campaigns. The price of Bitcoin is volatile because there is still a significant release of new supply through block rewards. However, with the halving, the block rewards are reduced by half, which will increase its scarcity. Next, let's talk about how risky Bitcoin is from the liquidity perspective. Bitcoin is one of the most liquid assets, and its market is open 24 hours a day, non-stop, without holidays. This is different from the stock market or the SP 500, for example, which have holidays and do not operate 24 hours non-stop. The best place to trade our Bitcoin, in my opinion, is Bybit. Because Bybit provide ultra-low latency, deep liquidity, and zero downtime crypto trading platform. With ultra-low latency means you can avoid order loss when you trade your Bitcoin. So if you want to use Bybit, please use the link below as a way to support our channel. You will get welcome rewards from Bybit, so it will be a benefit for both of us. What about the safety of Bitcoin? Bitcoin is the only asset with significant value that provides full ownership in our own hands. While fiat currency is typically held in a bank, and its legitimacy is determined by a third party, gold is usually stored in a safe deposit box, making it difficult to move large amounts. Stocks require a custodian. Real estate ownership is registered with the National Land Agency and is limited to specific jurisdictions. Now, Bitcoin is different. It is the only asset that allows us to take complete control and have full ownership without the need for a third party, custodian, exchange, or marketplace. We can self-custody our Bitcoin, eliminating the risks associated with insecure custodians, exchanges, marketplaces, banks, or other third parties. Well, when it comes to discussing the security of our assets, Bitcoin is secured using SHA-256, a military-grade security system developed by the National Security Agency of America. SHA-256 is a hashing algorithm used to convert text into a 256-bit string. And there is an extremely low probability of guessing someone's seed phrase. Next, how risky Bitcoin is comparing to any other assets. Comparing to real estate is definitely illiquid, and our assets are stuck in one location. The same goes for stocks. Our assets are stuck in a specific jurisdiction. In essence, each has its own risks. Only Bitcoin, it is the only asset or money with all the characteristics of gold, plus ultra-portable, ultra-secured, limited supply, deflationary, and becomes more valuable over time because of the scarcity and adoption. And it is much riskier if we don't have Bitcoin compared to if we have Bitcoin. Because Bitcoin is our financial lifeboat, our escape money. When compared to stocks, it's not an apples-to-apples comparison, because stocks are a business. They have directors, CEOs, owners, and products. Bitcoin is not a company. It doesn't have CEOs, directors, or employees. Bitcoin is a decentralized and immutable blockchain protocol. Decentralized means that there is no single institution or party that controls the entire blockchain protocol. Immutable means that what is written in the blockchain cannot be changed by anyone. Next, we will start talking about technical matters. We will use the perspective of institutional investors who manage millions or even billions of dollars. How do they view the risks from an institutional standpoint? So, how risky Bitcoin from Sharpe ratio? The Sharpe ratio indicates how well it performs compared to a risk-free investment such as U.S. government bonds. The Sharpe ratio is a tool to measure the risk of an investment asset using this formula. I don't want to put much details in the video, but basically, Sharpe with a value above 1 is considered good, while above 2 is considered really good. and a value of 3 is considered perfect. For Bitcoin, the Sharpe ratio score is 1.71, which is quite good. Next, how risky Bitcoin from Omega ratio. Omega ratio with a value greater than 1 indicates a good ratio between risk and performance. Means it has a greater likelihood of reaching its target and a smaller likelihood of experiencing significant losses. Omega ratio of 1 means that the asset has a 50-50 chance of achieving returns and a 50 chance of experiencing significant losses. Omega ratio less than 1 indicates a portfolio with a small likelihood of achieving the expected return. And the good news is that the Omega ratio of Bitcoin is at 1. Next, how risky Bitcoin is from Ulcer Index. Ulcer Index is a powerful tool designed to measure the volatility and drawdown of an asset. This tool was developed in the 1980s and calculates the magnitude of price declines and their duration. What's unique about the Ulcer Index is that it emphasizes price declines more than its gains. So, it is more reliable in calculating the psychological impact on investors and its relationship with market conditions. Low Ulcer Index means that the asset has experienced a relatively small drawdown within a certain period. High Ulcer Index means that in the past, this asset has experienced significant drawdowns. What about Bitcoin risk from Sortino ratio? Sortino calculator has been used by many investors to evaluate the quality of an asset, similar to the Sharpe ratio we discussed earlier. But the difference lies in how its risk is calculated. The Sharpe ratio uses volatility as a measure of risk. That's why an increase in the price of an asset will decrease its Sharpe ratio. Sortino ratio, designed by Dr. Frank Sortino in 1980, helps investors calculate the risk and reward of an investment. The higher the Sortino ratio, the better the asset becomes an investment target, because its return is much greater compared to its risk. A negative Sortino indicates that not much information can be derived from it. Sortino ratios between 0 and 1.0 are considered less favorable. Sortino ratios above 1 are considered acceptable. Sortino ratios above 2 are considered very good. Sortino ratios above 3 are considered perfect. Now, the Sortino ratio at the time this video was made was at 2.5. It is considered very good, and its potential reward is much greater than its risk. But it is important to remember that the ratios we discussed here are also subject to fluctuations depending on market conditions. But after more than 14 years of existence, with consistent growth, with more information and education about the history of money and the financial system, and with institutional adoption, in my personal opinion, Bitcoin is no longer a high-risk asset and is very different from the view a few years ago. Bitcoin is also considered a high-risk asset due to the lack of education about Bitcoin and people's knowledge about Bitcoin being limited to trading. Yes, Bitcoin can be traded, but Bitcoin is more than that. Bitcoin is gold 2.0, a hedge against inflation, a hedge against bad government, decentralized money, real estate 2.0, anti-inflation, anti-censorship, limited supply, ultra-hard money. So we have discussed the level of risk in Bitcoin. But in my opinion, it is far riskier if we don't have Bitcoin. Why? Because by keeping our wealth in the form of fiat currency, it means we have a risk when the bank where we keep our money experiences a bank run, as has happened in many banks worldwide due to mismanagement or the illegal use of customer funds. We also have a risk of being canceled or censored by the bank, like Kanye West. We also have a risk of inflation or even hyperinflation. In fact, the value of our currency has decreased by 99% since 1930. We also have a risk of a bad government because fiat currency is limited to a specific jurisdiction and cannot be physically taken out of the country. So which one do you choose? The risk of having Bitcoin or the risk of not having Bitcoin at all? Share your thoughts below. My name is Seth Noah. You are watching Decentral Money. Please subscribe to our channel as a way to support us.